Basically, that's why asset encumbrance is a topic. It's one of the things we have in our program. Is because if it is encumbered, the RSF, the denominator of your NSFR, is negatively impacted. So it's an issue. And of course, if you were previously funding through, covered bond programs, securitization, for example, what I call the Scandinavian funding model, then NSFR is difficult to meet. Okay, anything else, Enrique?
No, I mean, obviously encumbrance is an issue. Some business models, I was saying, matchbook dealing, and that's something that's covered as well in CP 2116 in terms of Pillar 2 risks. So there's different particularities that need to be taken into account when looking at how to optimize the balance sheet.
Okay, and that's definitely one of them. So you need a higher level ALCO-driven strategic LM discussion about all these factors coming in. Okay, which is one of the points about LCR and NSFR not being joined up. Peter, that was your comment about capital and liquidity. I mean, they've all been done in isolation, haven't they? Leverage ratio, and I think, Graeme, your point about it's all ratio based now. There's the capital requirement, there's a liquidity requirement, there's a leverage ratio requirement, and they've all been done without being joined up. So what's the solution? How should we optimise a balance sheet given that they aren't joined up? Like I said, we don't just want to sit here and gripe. We want to have a recommended policy action to go forward. I have some thoughts. I just wonder any thoughts on what's the solution given that they aren't joined up?
Don't lend to SMEs.
Don't do any lending.
People can only look at their business models and cut back hard on types of funding that aren't attractive. And I was at a conference with a major UK bank, and some big corporates wanted to leave deposits, and they got questions like, well, do you do foreign exchange with us? Do you do swaps with us? And the customer was very confused. I want to give you money. And the client was complaining, why are you asking me about FX and swaps?
Yeah, right.
And it took a while. They had to say, well, I'm not doing that because I don't get the treatment I need for my liquidity on taking those deposits.
Precisely, that's right.
And so I have to make a lot of money off you on something else.
Yeah,
or we're going to have to say goodbye.
That's exactly it. That's exactly it. Actually, in fact, larger corporates will find it hard to place cash because of the LCR outflow treatment of them. And they'd happily place cash at zero. In fact, some of them may well start placing cash when it's a negative. In fact, they have to in the Euros anyway. In the Eurozone, it's a reality. It's negative rates right now for large corporates. Okay, right. Let's. Any questions in the room or nothing on the screen? No. Okay, no questions. We'll carry on then. Right, we'll press on.
Just on that issue, adapting the business model against the backdrop of the LCR as well is that the limitation on the inflows side of things also tends to discourage interbank placements now as well. So the money markets used to be really vibrant. I'm talking pre-2007. Then they got a big smack after the crisis. But this seems to be the final nail in the coffin for interbank lending, I think, in some ways. So, strangely, that should and would encourage banks to buy more securities and hope for a better treatment on that basis.
Right. Now, it is time, in some respects, for some of the pendulum, and it would be fantastic if someone from the Basel Committee was watching this forum. It is time for the pendulum to swing back slightly. I wonder if the solution is this. Interbank market liquidity is a, inverted commas, good thing.
It is.
Okay, it's a good thing. If you penalise via LCR, NSFR, wholesale markets in their treatment of it so the liquidity dries up, that's not good for the world, right? The economy. I wonder if the solution is to water down the punitive treatment of wholesale funding, but at the same time require banks that use it to have a more conservative, for example, loan-deposit ratio. I mean, what's wrong with saying, I can see why you think short-term wholesale funding bad, customer funding good, if you were running 180% loan-deposit ratio, and every time you lent money, you just borrowed it in the overnight from a bank, and then when there's a crash...
Northern Rock.
Yes, Northern Rock style, or one or two other banks I can think of. But what if you said, okay, we have a very conservative... funding regime, we are surplus customer funded, but we do take some money from the money markets. When we do that, don't penalise us. Don't treat it under LCR as type A, or maybe that's the solution.
So you think judgment would be okay? Which judgment is out. Everything is prescriptive now.
Yes.
But of course, in a prescriptive world, then that's enforceable stuff. So that means it has to be obeyed to the letter of the law.
Correct. Whereas if it's judgment related, it's harder to enforce. But if one
But
was
it could
running,
work. But it could actually
well,
work.
if one was running a sensible liquidity regime, balance sheet funding regime at the whole,
Yeah.
then I could make the case
Yeah.
that wholesale funding
Has a
shouldn't be
place.
treated. Yes,
Has a
precisely.
place.
And I think that's where the pendulum. When I say the pendulum should start swinging backwards, I don't mean we just unwind all the stuff from 2008. I mean start being sensible about it and treat certain types of funding not as the bad things they are, provided the bank as a whole at the aggregate level is running a sensible funding regime for the whole balance sheet. I think that would make.
Were they calibrated right in the first place? Are these retail deposits as sticky as they're supposed to be?
Yeah. I mean, that's an absolute.
Maybe that's a bad example.
We have wholesale deposits that I would contend are stickier than a lot of retail.
Than some
deposits.
internet deposits,
Yeah.
absolutely. I can see that.
Yeah.
I can see. Yes, I know. In fact, I know. I
You
can
know
probably guess
exactly
that.
what- you know
I know
exactly
exactly
what
what
you're
you're talking about. There is a class of wholesale deposit customer that could be with you for 20, 30 years, as we can demonstrate.
Yeah.
And there is a class of retail customer who just looks at the
basis point.
yes, they look at the moneysupermarket.com. Now, for those of you around the world who aren't necessarily using moneysupermarket.com, what I mean is a kind of website that is comparison website. It just shows you the best rates in the market. And they just switch their funds at the click of a mouse button to the bank paying the highest rates. And if it's in a country with a deposit compensation guarantee scheme, you've got no problem. It could be the dodgiest bank in town with the lowest credit rating in town. But if your deposits are covered up to 75,000 euros, as they are in the European Union, you'll place your money if they're paying an extra 20 or 50 or 100 basis points. So that type of funding isn't sticky, whereas some of the wholesale customers that you and I are familiar with, they could be with you for as long as the bank had been around. And I think some sensible judgment there would make a lot of sense. Okay.